Good morning, everybody, and welcome to this month's webinar. And this month, we're focusing on getting ready for 30 June 2018. Over the last number of months, we've looked at IFRS 15, the risk assessment, problem areas, transitioning to IFRS 15. This month, we just focus on getting ready for 30 June, and then next month in June, we continue with IFRS 9 and later in the year, IFRS 16. So welcome to this webinar, and I hope you get a lot of useful information out of it. You would have seen that we've sent out an email with two attachments. The one is a PDF of the PowerPoint slides that I'll be using, and the other one is a decision tree that I'll explain a little bit later. If you haven't received the email, you should also be able to go to the handouts section on GoToWebinar, and you should be able to download those two documents as well. So if you didn't get the email, please go to the handouts section and you should be able to download it from there. If you want to ask any questions or make comments, there's a question box and a chat box, as you know, as always. So, getting ready for 30 June, the outline of this webinar, what will we discuss today? I want to start with the future of special purpose financial statements. Now, there's been big changes, or there are big changes on the horizon, and I just wanted to give you an overview of that. So I'll start with that. I would say that might be the biggest news in the accounting world at the moment. Then we'll look at significant global entities. The third thing, we'll look at the tax rate changes. We'll then, just at a very high level, look at the new Australian accounting standards that are applicable for 30 June 2018 full years. So what would be new? What are the new things you have to make sure you consider if you're doing 30 June annual reports? We'll also look at what if you are preparing half-year or interim accounts for 30 June 2018. What new accounting standards should you consider? We'll give you a brief overview of the ASIC focus areas, and I also looked at all the recent ASIC enforcements and give you a bit of feedback on that. We'll just touch on the disclosure initiative and actually the new practice statement that was issued by the International Accounting Standards Board. Second last on the list, I ask, are you ready for AASB 9, 15, 16 and 1058? 1058 for our not-for-profit entities. Are you getting closer to being ready? Have you started a project and a process? And the very last thing, you might have seen on our BDO website, on our LinkedIn page, that towards the end of last week, we've launched BDO Lead. Now, BDO Lead is our BDO technology solution to do all the IFRS 16 calculations on transition and going forward, and it's also a lease management tool. Now, that is the tool that was implemented by Deutsche Telekom in Germany, and they've got more than 10,000 leases. We are now also selling that in Australia. So if you're interested in that, please contact me and I'll give you a bit of information about that at the end of the webinar. So I'm very excited about BDO Lead because we've been talking about these new standards and all the problems they are posing. And at least here we've got a solution that can actually help clients. So if we start with the future of special purpose financial statements, I want to start with the decision tree. Now, this decision tree, I'll try and bring on the screen. You would also have seen it attached. You should now be able to see it. Now, this decision tree is one that we've prepared quite a while ago to try and get some clarity around which Australian accounting standards entities should comply with. Now, I have to say, and I'm very honest about this, as an immigrant, now I came to Australia in 2002. It actually took me a long time to get my head around reporting entity concept and what it means for all the different types of entities in Australia. I think I only finally got my head around it when I was working at the Australian Accounting Standards Board as a project manager. And I could ask a lot of people, they put this in perspective. Why do we have it? What does it mean? And really over the years, I've worked on this decision tree and fine-tuned it. And every time I look at it, I actually, kind of try and improve it as well. This is a very difficult concept. So let's start with the current position in Australia, and then I'll try and explain what proposals are on the table. Now, currently, if you want to know, any entity want to know what is the applicable Australian accounting standard, you have to ask with the question, is the entity a reporting entity as defined in SAC 1, Statement of Accounting Concept 1? And in SAC 1, there's a lot of guidance on whether you're a reporting entity or not. I suppose the principle is if an entity has users that make decisions only based on the financial statements, they don't have access to other information, they can't demand other information. These users only make decisions. Whether to provide financing, whether to buy shares, sell shares, whatever decisions. They only make decisions on this set of financial statements. That's all they've got. Then usually that entity would be a reporting entity. Now, there's a lot of other things to consider, but that's a principle, very high level. So if an entity is a reporting entity, and you've answered yes, so we go to the left-hand side of this decision tree, then you have to prepare general purpose financial statements. And if you have to prepare general purpose financial statements, there's a next question for you to consider, and that is, does the entity have public accountability as defined in AASB 1053? Now, again, it's a new standard and it talks about public accountability, yes or no. If you've got public accountability, you have to prepare general purpose financial statements. You are tier 1, which means you have to comply with all the recognition, the measurement, the disclosure, absolutely everything in the Australian accounting standards. And if you're in this tier 1, you can also state compliance with IFRSs. So the people that would be in this tier 1 would typically be your listed entity, your public interest entities. They have public accountability, right? However, if you said I'm a reporting entity, but you've looked at AASB 1053 and you don't have public accountability, then you've got a choice. You still have to prepare general purpose financial statements, but you have a choice to either voluntarily comply with all the recognition, measurement, disclosure of all accounting standards, and then you can state compliance with IFRSs. So you voluntarily say, I go to tier 1 requirements, or you can say, listen, I'm tier 2, I'm happy to be tier 2, therefore I'm going to do all the recognition and measurement of the accounting standards, and I'm only going to do the reduced disclosure requirements of all the Australian accounting standards. So recognition means all your debits and credits, measurement, fair value, etc. So you're going to do recognition and measurement, but you're not going to do disclosures. So if you look at an accounting standard, the paragraphs in the disclosure section that's been grayed out, those are the disclosures that the RDR tier 2 people don't have to do. So if you get a standard, you'll see there's a lot of disclosures. As soon as it's grey out, everybody in tier 2 don't have to do that. I think what's really important, and it becomes more important as we move on with this discussion, is if you're preparing general purpose financial statements, and if you're in tier 2 and you're doing these reduced disclosures, you cannot state compliance with IFRSs. because you're not doing all the IFRS disclosures, but also you have to do consolidated financial statements. So if you're doing general purpose financial statements, whether it's tier 1 or tier 2, consolidation is part of it. The only difference between tier 1 and tier 2 is the extent of the disclosures. All right. So that is if you're a reporting entity and you're preparing general purpose financial statements. If we move back to the first question and you've said, listen, the entity is not a reporting entity. You've looked at SAC 1, the directors have made an assessment, the entity is not a reporting entity, then the entity can prepare special purpose financial statements. Now, when we look at special purpose financial statements, you know exactly which accounting standards you have to comply with in this special purpose world really depends on what you're doing with the financials. So I've distinguished here between, let's say you're a Corps Act entity. Let's say you're lodging with the ACNC. And then my third column is other entities. So you're not a Corps Act entity, you're not lodging with the ACNC. So you are preparing financial statements because there's a trust deed, you're an incorporated association, a partnership, any other entity preparing financial statements, these special purpose financial statements. You know, what accounting standards do they have to comply with? So those are the different criteria. So if we move more or less to the middle of the decision tree and we say, remember, we're now in special purpose world, and let's say we're a Corporations Act entity. Again, Corps Act entities I've split into two. On the left-hand side, I've got disclosing entities, public companies, large proprietary companies, registered schemes, foreign-owned companies. Now, a large proprietary company, you know, there's a paragraph or section 45A in the Corps Act that gives you guidelines on when would you be large, and there are 3 limbs, and if you pass 2 of the 3, you would be large. So it's around size of your assets, revenue, and number of employees. So if you're a Corps Act entity and you're one of these disclosing entities, public companies, large proprietary companies, registered schemes, foreign-owned companies, that means you have to prepare and lodge audited financial statements in terms of Part 2M3 of the Corps Act. And then important, the block at the bottom, if you are preparing and lodging special purpose financial statements, because remember, if you're doing general purpose, you would have been in the green area anyway. But if you are lodging special purpose financials with ASIC, because you meet any of these criteria, ASIC has a regulatory guide that says, Regulatory Guide 85, that you have to do recognition, measurement, and disclosure of, so this is everything of AASB 101, 107, 108, and so those are the 3 key standards. 101 is presentation of financials, 107 cash flow, 108 accounting policies, changes in accounting policies, prior period errors, etc. And then there's also another, 1048, your interpretations, 1053, which says whether you are eligible for RDR or not, etc. Specific disclosures in Australia. So if you're doing special purpose, you have to comply with these standards in full. But they also say in ASIC Regulatory Guide 85, you have to do the recognition and measurement of all other Australian accounting standards. So these standards, you do recognition, measurement, and disclosure. All other Australian accounting standards and interpretations, you have to do the recognition and measurement, the debits, the credits, the values. But very important, according to ASIC Regulatory Guide 65, if you do special purpose financials, you don't have to consolidate, because consolidation there is deemed to be a disclosure standard and not a recognition and measurement standard. So this is the current position. So what does this mean? This means if you lodge special purpose financial statements with ASIC, you could currently lodge separate parent entity financial statements with ASIC. So parent entity financial statements, you don't have to lodge consolidated financial statements with ASIC. And that is about to change, so I'm putting you on notice already. If you go back to Corps Act entities and you do you're a small proprietary company, you are required to prepare special purpose financial statements. No need to lodge them with ASIC. And now the question is, what are the relevant Australian accounting standards to comply with? I think the general principle is you have to comply with the accounting policies outlined in Note 1 of your financial statements. And our BDO view is that even though you're a small proprietary company, we would like special purpose financial statements to comply with the recognition and measurement of all the accounting standards, even though you're small proprietary. That's our view. However, if we move on this decision tree and we move to not-for-profit entities lodging with the ACNC, you can see this block here is very similar to Corporations Act entities that are lodging special purpose financial statements with ASIC, that prepare and lodge special purpose financial statements with ASIC. So it's a number of the standards. You have to do everything, including disclosures. For the remainder of the standards, you have to do all recognition and measurement, and also consolidation not required. There's an extra N in there. I can't type. Right on the right-hand side, other entities. My question is, why is the entity preparing financial statements? Is it required by legislation, by a trust deed, by the bank, etc.? And if you want to know which accounting standards to comply with, you have to ask what are the requirements of the relevant legislation, trust deed, etc. And that's why I've got a question mark there. What do they say? What do they want? So this is a decision tree that I've tried to discuss very fast on deciding which are the relevant Australian accounting standards or the applicable accounting standards at the moment. Now, this is about to change. So if I just close this and I go back to my slides, you'll see why are things changing, first of all. Now, on the end of March, the 29th of March was the Thursday before Easter weekend. The International Accounting Standards Board said, Happy Easter. And they've issued a revised conceptual framework, and I'm just going to refer to it as the framework, which applies to, or which will apply to, annual periods beginning on or after 1 January 2020. Now, this revised framework will be adopted by the AASB in Australia. And the problem is that this framework has a different concept of reporting entity than the definition or the concept of reporting entity that we have in SAC 1. So it really is a problem. We cannot have two conceptual frameworks. I mean, the conceptual framework is whatever underpins all accounting standards. So if the IASB have a conceptual framework that underpins IFRSs, and we in Australia have adopted IFRSs, we need to adopt the same conceptual framework. And if there's this inconsistency around the definition of a reporting entity, really the AASB have no choice than to remove SAC 1. Or to get rid of that concept of reporting entity. Now, this new international framework in paragraph 310 says that a reporting entity is when an entity is required or chooses to prepare financial statements. So internationally, as soon as you have to prepare financial statements, you're a reporting entity, or as soon as you choose to prepare financial statements, you're a reporting entity. And then they go on and provide a bit of guidance on the boundaries of this reporting entity, so what's captured or not. So it's a very different concept. Now, in anticipation of this revised framework, the AASB have discussed and noted that in order for them to be compliant and in order for Australian accounting standards to be compliant with international accounting standards, the concept of a non-reporting entity in Australia would need to be removed, because it's very important for especially our tier 1 entities, as I've explained on that decision tree. Those tier 1 entities, our listed entities, our public interest entities, they don't only want to state compliance with Australian accounting standards, they also want to be compliant with IFRSs. So really the AASB have been forced to make a change. So what is the expected change in Australia? Now, the expected change, number one, that SAC 1 will be withdrawn. The second thing is that the application paragraphs of all Australian accounting standards will have to be amended to remove any references to reporting entity. So you can no longer say, listen, you only apply this accounting standard, whichever one it is, if you're a reporting entity, because Australian accounting standards will have to be applied to all entities that prepare financial statements or choose to prepare financial statements if we want to get to compliance with IFRSs. So the outcome of that really is that the idea, or it is envisaged, that wherever financial statements are required to be prepared in accordance with Australian accounting standards, for example, you are required to lodge financial statements with ASIC or the ACNC, and they want you to prepare and lodge financial statements in accordance with Australian accounting standards, then those financial statements will have to be general purpose financial statements. However, if there's no requirement to comply with Australian accounting standards, for example, your bank would like you to prepare financial statements and they don't say it has to be in compliance with Australian accounting standards. They just say, we want you to prepare financial statements. Then there would still be scope to do special purpose financial statements. But you can see the big thing here, and the AASB has done some research. Apparently, around 80% of entities who currently lodge financial statements with ASIC lodge special purpose financial statements with ASIC, which means that cohort that are currently lodging special purpose financial statements with ASIC in future will have to lodge general purpose financial statements with ASIC. And then obviously they'll have to decide whether they're general purpose tier 1 or tier 2. And I would suspect most of them will qualify for that RDR tier 2. But still, it's a big change. And I'll explore that a bit further. Now, so what does this mean? Whenever financial statements are required to be prepared in accordance with Australian accounting standards, general purpose, no requirement, there would be scope to prepare special purpose. You can still elect to do general purpose. So I thought my decision tree is going to change drastically. After I've spent the last 16 years tinkering with that decision tree, it's going to come down to this. If an entity wants to know which Australian accounting standards they have to comply with, the question will be, is the entity required to prepare financial statements in accordance with Australian accounting standards? Yes, you prepare general purpose. No, you can decide whether you want to prepare general purpose or special purpose. So if you're not required to comply with these Australian accounting standards, you've got a choice. As soon as you say, I choose to prepare general purpose, you choose to comply with Australian accounting standards. If you say, I'm not required to prepare financials in accordance with the standards and you want to do special purpose, that would be acceptable. So my question is, if we go to potential practical implications, I'll start with the elephant in the room, really. Are you currently lodging special purpose financial statements with ASIC or the ACNC? Are you one of the 80% of the companies lodging with ASIC who are lodging special purpose? My next question then for you would be, are you complying with all the recognition and measurement requirements of all Australian accounting standards? Because the AASB have done research and they found that there's quite a bit of a percentage of these people who lodge special purpose that it's not clear whether they're complying with the recognition and measurement, or they explicitly say there's certain standards we're not doing the recognition and measurement. So, you know, where do you fall? The second bullet point there, however, is the big one. Are you currently lodging parent entity special purpose financial statements with ASIC? Because a number of people have a parent entity, and below the parent entity there are a lot of other operating entities or operating trusts, etc. Because currently you can lodge special purpose financial statements with ASIC and you don't have to consolidate because consolidation is deemed to be a disclosure standard, you only have to lodge the parent entity accounts. Now, if that is the case, that's a big change for you, because going forward, you'll have to lodge consolidated general purpose financial statements with ASIC. So if you're not lodging with ASIC or the ACNC, but you are currently preparing special purpose financial statements, I would encourage you to, as soon as possible, inquire and have a look. What are the requirements of your trustee, your association, your regulator, your bank? So what do they want you to do? Prepare financial statements in accordance with what? If they say in accordance with Australian accounting standards, then you'll have to comply. You'll have to prepare general purpose financial statements. So very important to be aware of these potential changes. Timeline or expected timeline. The AASB has issued a consultation paper, so they are consulting. And if you've got a particular view, you can contact the AASB directly or put in a submission. I'm also very happy for clients to contact me with particular concerns or views, because we will be providing feedback to the AASB as well. So there is a consultation paper out that you could look at. It's on their website. It came out very recently. There was a round table in Melbourne on Monday. The timeline for, if I maybe go back, did I close it up? That decision tree. If you're a tier 1 entity, a listed entity, you can imagine that it's very important for them to keep IFRS compliance. Therefore, this new conceptual framework and the removal of SAC 1, which really doesn't impact them because they're all reporting entities, will come into effect for years beginning on or after 1 January 2020. For large proprietary companies, for other people preparing special purpose financial statements, they haven't committed to a date yet. I think it depends on the outcome of the consultation. In my mind, I'm trying to get my head and clients ready for financial years beginning on or after 1 January 2020. So it's an interesting thing. If you look at the timeline, 1 January 2018 is when we have to deal with IFRS 9 and 15. 1 January next year, 2019, it's IFRS 16 and AASB 1058. And then a year later, 1 January 2020, a potential big change to special purpose financial statements. So it's a number of years of constant changes. We don't have a firm date for this. The earliest would be years beginning on or after 1 January 2020. And I'll keep you informed as we go along with our webinars during the year as we get more information. So that was really the biggest part and the biggest new information that I wanted to cover. The next section that I want to look at is significant global entities. Now, this is interesting. And I've positioned it just after special purpose financial statements, because you will remember, we've talked about this before in our update for December and our update for June last year, that the tax laws have been amended. So this is not the accounting standards, the tax laws have actually been amended in December 2015. And the tax law now requires significant global entities, SGEs, to lodge general purpose financial statements with the Commissioner of Taxation, with the ATO, if that entity is not already lodging general purpose financial statements with ASIC. So the 80% of the people who are currently lodging special purpose financial statements with ASIC, if they are part of a significant global entity, they have to lodge general purpose financial statements already with the ATO, and the ATO have told us they will then provide those general purpose financial statements to ASIC, which will put it on the public record. So what is a significant global entity? Now, if you've got a global parent with an annual global income with more than 1 billion Aussie dollar, or you're a member of a group of entities consolidated for accounting purpose as one, and one of the other entities in the group have annual global income of more than 1 billion Aussie dollars. And so this is all about making sure that multinationals are paying enough tax in Australia. And you will see here, when will these changes be effective? It was already effective for 30 June 2017 year end. So you might say, Aletta, this is old news. It's not old news, because a lot of these entities are only lodging their 30 June 2017 tax returns as we speak. And therefore, over the last number of months, a number of our tax partners have been speaking to us in IFRS advisory around preparing general purpose financial statements for their tax clients in order to get lodgements done. Now, you can see this is similar to what the AASB is proposing, in that there's a big movement in Australia to get rid of special purpose financial statements. Whether it's coming from the ATO or the AASB or the regulators, it's on. And that's why I think we should start to get ready for this. So which entities will be impacted by the tax changes? If you lodge general purpose financial statements with ASIC, obviously no impact, you're already doing it. If you currently lodge special purpose financial statements with ASIC, you have to upgrade and you'll have to lodge general purpose with the ATO, and that can be tier 1 or tier 2. Remember, tier 2 is the reduced disclosures. If you're not currently lodging with ASIC, but you're part of an SGE, for example, large grandfathered private companies, they now have to lodge general purpose financial statements with the ATO. It will go to ASIC on the public record. So even those grandfathered entities will be impacted. If you're small foreign controlled, and if you've used the old class or the 9898, you still have to do general purpose financials and lodge with the ATO. So quite a bit of impact, that's already big impact already in place, and now the AASB is also coming with changes. But interestingly, the AASB have tried to change this about 7 years ago. This time, however, it's not just the AASB who want to change it. The AASB has really been forced by the International Accounting Standard Board, issuing this new conceptual framework with a different definition of reporting entity. Tax rate changes. Now, again, we have talked about this at the end of last year. There were some tax cuts passed through Parliament last year, where they say the corporate tax rate of 27.5% will apply for certain companies. In the recent budget, again, certain tax cuts proposed. It's not through Parliament yet, so it's not substantively enacted yet. We're only looking at those tax cuts that's gone through Parliament. So what changes do you need to make to your financial statements? If there's a reduction in the corporate tax rate, if it is effective in a particular year, it would impact your current tax and your current tax payable. If it's not effective in a particular year, it can still impact your deferred tax, because your measurement of your deferred tax asset or liability should be based on the tax rates that you expect to apply in the period that that asset is expected to be realized or the liability settled. So a more complex calculation, as in when do we have the deferred tax implication and what is the expected tax rate in that particular year. So that's a bit of work. If you look at the next section, Sarah, I just want to take a sip of water. If you are preparing financial statements, full year financial statements, 30 June 2018, there are only 4 new standards. If you're for-profits, it's 3, not-for-profit 4. So the first one is AASB 2016-1, and this one is really clarifying 4 issues regarding the recognition and the measurement of deferred tax assets. So it's all around when we do this calculation of deferred tax assets on unrealized losses, you know, how do we apply it? There were some practical problems, there was some diversity in practice for particular issues. And in our November webinar, I've provided a number of examples and stepped you through these changes. If you've missed that webinar, all the recorded webinars are on our website. So if you want to see examples of these, November 2017 webinar. The second one is AASB 2016-2, and that is around the disclosure initiative and specifically around changes to AASB 107 cash flow statements. So important, in your cash flow statement, there's now additional disclosures that will be required for changes in financial liabilities that arise from cash and also non-cash flow items. So in your cash flow statement, please have a look at that. I've given you example in that webinar on what it should look like. The third one for-profit entities is actually the one in the top right-hand corner, AASB 2017-2, and that's some annual improvements. So as you know, the annual improvements are small amendments to a number of standards to clarify their meaning. So there are a few of them around AASB 5, non-current assets held for sale and discontinued operations. There's also a little bit of change to AASB 12, which is disclosure of interests in other entities. And then the red one on the slide is the one that only applies to not-for-profit entities, and that is around the recoverable amount of non-cash generating specialized assets of not-for-profit entities. Now, this standard clarifies that the AASB considers depreciated replacement cost used for impairment testing in AASB 136 and current replacement cost used as a method to determine the fair value of an item in AASB 13 to mean the same thing. So this was quite a big amendment. Depreciated replacement cost, which is something not-for-profits use for impairment testing, mean the same thing as fair value, mean the same thing as current replacement cost, which is a method that not-for-profits use to determine fair value. So that is an interesting thing for our not-for-profit entities. Now, if you are preparing half-year accounts, 30 June 2018 half-year accounts, so your year end 31 December, you will have the joy of adopting IFRS 9 and IFRS 15 in your interim set of accounts. They will be mandatory. Now, this has a big implication. And my question to you is, what are you going to disclose in your 30 June 2018 half-year accounts in relation to the adoption of IFRS 9 and IFRS 15? Because when we look at AASB 134 interim financial statements, there are disclosure requirements, etc. But the principle really is that you have your full year financial statements, and the previous full year financial statements would have been 31 December 2017. And in your 31 December 2017 financial statements, you would have applied the existing or the old AASB 118 for revenue and the old AASB 139 for financial instruments. Now, 6 months later, you do an interim set of financials, and remember, an interim set of financials provides an update of your previous full year financial statements. So when you provide that update, in that update, you have to disclose significant new accounting policies and significant changes. I think it would be really hard to argue that the adoption of IFRS 9 and 15 was not a change in accounting policy, or was not a significant event or significant change. And therefore, I'll find it really hard that you can just merely update it. I would actually expect quite extensive disclosures around IFRS 9 and 15. Because you can't just update on what you've done in terms of 118. You have to say, this is my new accounting policy in terms of IFRS 15. This is my new accounting policy in terms of IFRS 9. It's not new. It's not just an update. It's new. And also important to disclose to users, what does this mean? What's the impact? So if you're doing half-year accounts, I would really ask you to consider, how are we going to tell the story to our users in the half-year accounts? Can we just update, or do we need extensive disclosures? And personally, I believe you will need quite extensive disclosures. If we look at the ASIC focus areas and the enforcements, let me just get the enforcements in front of me. The ASIC focus areas, they haven't released their focus areas for 30 June 2018, but over the last 3-4 years, their focus areas have not changed drastically. Therefore, I've gone with the focus areas for 31 December last year, which you can put into four main categories. A category around accounting estimates, more and more accounting estimation, impairment testing, incredibly important, determining asset values, so fair values, incredibly important. So all those accounting estimates, very important. And you can imagine with the new IFRS 15, there's also a lot of accounting estimation around IFRS 15. So accounting estimates becoming more and more important. The second bucket, accounting policy choices around off-balance sheet arrangements. You know, IFRS 16 is actually a standard that was trying to bring a lot of off-balance sheet financing through operating leases onto the balance sheet. We also had the changes in AASB 10 to address special purpose entities being off balance sheet. So that's still a focus for them. Revenue recognition, the new IFRS 15, very important. But even if you're still applying the existing AASB 118, are you applying it correctly? Expense deferral, you know, if you want to defer expensing certain items, therefore you want to capitalize an asset, do you meet all the criteria, especially in AASB 138 intangible assets, to capitalize the research and development cost? Research cost always expense, development cost you can capitalize if you meet a number of strict criteria. But really, as soon as you want to book an asset in terms of any standard, you know, do you meet the requirements? Because if you don't book the asset, the alternative is an expense. So, you know, do you meet the requirements? And then they've put tax accounting on in the last year or so. and I find it quite interesting how they've explained it in the media release. They said, and I'm reading from the ASIC media release, tax effect accounting can be complex, and preparers of financial reports should ensure that there is a proper understanding of both the tax and accounting treatments, and how the differences between the two affect tax assets, liabilities, and expenses. They also say, you know, we have to consider the impact of any recent changes in tax legislation or recent changes in accounting standards, and we should consider the recoverability of any deferred tax assets and that it's properly reviewed. You'll remember that you always book a deferred tax liability, but for deferred tax assets, you would only book it if it's probable that there be a reversal in future and taxable profits in future. So tax accounting well and truly on the agenda. They've also got a category around material disclosures, and that is material disclosures around estimates and accounting policy judgments. Now, that material disclosure fits very nicely with the very first green block, accounting estimates. Because if we see more and more accounting estimates, ASIC will want more and more disclosures around our judgments on how did we come up with those estimates and how did we select those accounting policies. So the two go together. And then very important, the impact of the new accounting standards. Now I'll just put a timeline in your head. If your year end is 30 June 2018, and therefore you finalize your financials, let's say September or October 2018, that means you are, by the time you finalize and publish your financial statements in September, October, you are already 4 months into the year where you have to mandatorily adopt IFRS 9 and 15. Because mandatory to adopt IFRS 9 and 15 for years beginning on or after 1 January 2018. How can you then disclose in your notes to financial statements that you have not assessed the impact of IFRS 9 and 15 on your financial statements? I mean, you are 4 months into the first year of mandatory adoption. Therefore, ASIC is very keen to see that disclosure. IFRS 16, as you know, has a big impact on the balance sheet, on the assets, the liabilities, depreciation expense, interest expense. So it's just a few months away from that one. Have you quantified? Have you explained to users that although you'll now have an asset and liability, and although there are all these impacts on EBITDA, on profit before tax, on net current assets, etc., have you explained that your business model has not changed, your cash flow has not changed, but the accounting standard IFRS 16 has changed? So it's about communicating to users. And then the last one is the role of directors. And as you know, ASIC and I and the AICD and all these bodies very focused on the role of directors. So ASIC, I just want to flag with you, there's a lot of good information available issued by ASIC around impairment testing that you can look at. And this is aimed at directors, helping directors on what questions to ask. There's also material disclosures. You know, ASIC says we want to look at these disclosures, only disclose things that's material. Don't clutter financial statements with immaterial stuff, because if you have material and immaterial disclosures in a set of financials, you're confusing people. It should only be the material stuff. Otherwise, material information could be lost within a big set of financial statements. And then the role of directors, very important, directors are not required to be accounting experts, but they should seek an explanation from the CEO, from management, from the CFO, if they don't understand an accounting treatment. They should challenge accounting estimates and accounting treatments if it doesn't line up with their understanding of what the business is doing or what a transaction is. If they're not sure, they should seek advice to understand the substance of agreements. And there's particular documents, again, available to directors on their responsibilities. Then my question, are you ready for IFRS 9, 15, 16 and AASB 1058? If you're a for-profit entity, although you might be focusing on your 30 June financials, from 1 July, you have to apply AASB 9 and 15, and you are very close, just over a year out from mandatorily applying IFRS 16 leases. If you're a not-for-profit entity, you also have to deal with AASB 1058, and very important, in AASB 16, there's specific information around peppercorn leases, which has a big impact. Because if you've got a peppercorn lease, you'll have to book a right of use asset in terms of AASB 16, but that right of use asset should be the fair value of the right to use that asset. You'll credit a liability, which is the net present value of your $1 a year, and there will be a big income going to your financial statements. That sounds all good. However, remember that fair value of that asset will then be depreciated as you use the asset. So big impact for not-for-profit entities. Not-for-profit entities, the one that's going to hit them ASAP, if they've got a June year end, from 1 July they have to implement. If they've got a 31 December year end, already implementing. But the revenue standard, if it's applicable, the income standard, if it's applicable, and the leases standard, only for years beginning on or after 1 January 2019. Important, therefore, in your financials for for-profits and not-for-profits to disclose the expected impact of this new standard, the fact that there is a new standard and it might impact you, and an estimate of how it will impact you. And as I said earlier, how can you not know if you are already 4 months into the period that you applying this new standard? So please be careful. Disclosure initiative, you know, we've talked about this for many years, to remove unnecessary boilerplate disclosures. You can reorder it, you can regroup, you can re-emphasize. You know, an ASIC's view is that very happy for us to focus on material disclosures, as I've said earlier. The question, though, was how does a client decide what is material and what's not material? And there was a lot of debate around it, because this disclosure initiative has been around for a few years. And therefore, the International Accounting Standards Board didn't issue a standard, but actually issued a practice statement number 2, around making materiality judgments, where they explain that they suggest a 4-step process. And that is, step 1 is to identify the requirements of the possible standards that's applicable, but also to get knowledge about who are the users of your information. And then in step 2 is to assess the qualitative and the quantitative factors around materiality. So it's not just a number. There could also be qualitative items that you should consider, that by its nature it is important for users to know. Then they say organize the information within the draft financial statements, and then review the draft, get a fresh pair of eyes to read the whole thing and see whether we are telling the story, are we conveying all the material information to the users. I think it's really important that we sit back and say, and conceptually, financial statements are there to communicate to the users, whoever they may be, what's happened in this organization over the last year. And it's to communicate material items to them. So do we achieve that? Is our communication effective, efficient? And really important to maybe have a look at that. Then I would like to end with BDO Lead. What excitement, what excitement. So we've released BDO Lead in Australia last week. It was originally developed by BDO in Germany, implemented at Deutsche Telekom and a number of other big European entities. And on the website, you can see a lot of information about BDO Lead. Important if you're interested in a demonstration of the functionalities of BDO Lead. There's a webinar on Monday. I'll also record the webinar, put it on the website so you can see what it looks like, so you can register for the webinar. I have thought I'll show you the website. So if you go on our website, there's a page for this tool. There's a video there. I embarrassed myself by doing another video, so you can watch a video where I talk about BDO Lead. There's a button you can click to inquire about BDO Lead, and then I'll get back to you. There's also a webinar registration. If you click there, you can register for the webinar, and you can do it at the bottom as well. So there's a little bit of information about BDO Lead. What are the challenges? What are the benefits, etc. If you contact me, I can also send you a marketing document with additional information. So there's a few things for you to do. You can watch a video, you can send me an email by pressing the Inquire Now button, and you can register for a webinar. I would imagine, and what we're currently finding is entities who have, I would say, more than 20 leases are saying, I have to do a lot of amortization tables, and all of this have to be added together, and we have to do journal entries, and we have to do disclosures, and we have to do budgets. BDO Lead can do that for you, but it can also manage your leases. And so the nice thing is BDO Lead has an audit trail. So whenever you make a change to a contract or information on BDO Lead, it captures the date. And you've got administration rights for different users. So some people can just add new leases, other can amend leases, other do journals. Our IT consulting team at BDO is working with me. If you want this BDO Lead to actually integrate with your accounting software package, we can do that. At some of those large European entities, IT consulting has integrated BDO Lead with SAP as an example, so that can be done. If you want a dashboard with certain information, which leases are up for renewal this month, etc., IT consulting can do that. So if you contact me, if you attend the webinar, I can explain a little bit more, and I can actually show you what it looks like. Very easy to use. It is a web-based tool, but it goes on your server. BDO is not keeping any of your information on our server or in the cloud. It's on your server. If you want to use the cloud, you can do that, but it's your IT environment, your cyber security, all of that. So very important, if you're interested in this, please contact me. We're very excited that we've got a solution. So exciting stuff, please contact me. If you need any assistance, as always, we've got the financial reporting webinars every month. If you've missed one, you can watch recordings. Next month's webinar on the 20th of June is Transition to IFRS 9. If you need advice, you can always contact me, but if you're in Perth, please speak to Wayne. If you're in Brisbane, please speak to Clark. In Sydney, welcome to speak to Kevin, but always free to contact me as well. And then our team, we've got this big team in Australia. Very blessed to have such a big team. In New Zealand, we have another 4 IFRS people that we work together very regularly. And next week, I'm actually off to London for the week to meet with all the country leaders within BDO, or the large countries within BDO. We're all in London to talk about IFRS and latest developments and, learn from each other. So exciting to be part of such a big team. Thank you very much. I cannot believe it. It's 11:59. It must be the first time I finished on time. Thank you very much for joining me. Please send me emails with questions. Contact me if you want to know any more about BDO Lead, etc. And good luck with getting ready for your 30 June reports. Speak soon. Thank you very much.